Bada bing. Good day, everybody. Today we're going to start with a cool video. I don't know if it's a cool video. We're going to find out. But it comes from this guy, Hugh Hendry, who I heard about a few years ago, who I really liked before. He was kind of a macroeconomics finance bro. He made a lot of big money on the Japanese yen trade. That's where I learned about the whole Japanese yen trade, was from him. And what was it called? There was a documentary put out about it. I forget what it was, but it was an interesting documentary. And he definitely opened my brain up to a different perspective on the market. So I appreciated him for that. The last time I heard from him, which was probably 2 or 3 years ago, he was definitely a dollar bull. I never really heard from him in regards to Bitcoin, but it seems like in this situation, he's becoming a bit of a Bitcoin bull. We're going to find out together.
I've had this.
His stuff tends to be a little heady. I will do my best to break it down. By the way, I am Token Chef. None of this is financial advice because I'm a cartoon monkey, and that would be illegal for me to give you. So it's not, but I'll give you my perspective. Let's try to break this down, go point by point, and get his perspective on what the hell is going on here.
Presumption that the money dies every 100 years. We have so royally screwed up.
Oh, and for the record, this guy fucking crushed it in finance, and basically it's just retired on an island and just surfs all day long.
And this would be...
He ran a hedge fund for a while.
The death of money.
Meet Hugh Hendry, legendary hedge fund manager and macroeconomic analyst. He made his name by betting against the system and thriving in times of chaos, with a sharp eye for spotting opportunities where others see risk.
Forgive me, this is quite a rant. I did warn you.
Known as the acid capitalist, he's been staying ahead of the curve. Whether the markets are doing good or bad, he isn't afraid to challenge the norm and speak his mind.
You, my friends, are going to become insolvent like that. Your currency's bullshit. We are about to witness the death of modern money. Boom.
Being in the crypto markets for 8 years is like 80 years in the stock markets. It's just trading on steroids.
I will invest in anyone before I invest in the status quo. Give me the crazy guy.
When it shifts, it's going to be a disaster. What is that trigger going to be?
Cutting to the chase.
2025. Is it going to be a year where we're going to see a lot of surprises? I recall a tweet from yourself. I think it was the first tweet where you said, 2022, we were expecting no rate hikes from the Fed. 2025, we are basically expecting nothing to happen from the Fed either. And today, the Bank of Canada announced that they quit QT. What can we expect from the Fed going into the next months?
Well, I mean, really, this could be the only question of the show.
I know.
I probably will go on and on. I've been in Purdue. That's a term used to describe in the UK when the Chancellor of the Exchequer, before he announces his annual budget to Parliament, he disappears and doesn't make any public statements. I guess it's very similar to the period of about 6 weeks, quarter end, for companies reporting their earnings. And I've certainly spent, I think I recall it was 1 o'clock on Christmas Day, and I published my podcast. Mm-hmm. And I've done very little since. And is it because I'm mild-mannered? No. Is it because I'm lazy? It's not because I'm lazy. This time of year, it's just the end. It's the passing of a dear friend. I mean, I was just beginning to understand 2024, and now it's over. And now we have more...
Every time I watch this guy, I always try to focus so hard because it's hard for me. I mean, one is his accent's mild. That's not a big deal. But it's just his knowledge and the perspective he comes from. I really have to stay super locked in.
Questions. You cite one of my tweets. I wish to correct you. You cite my only tweet, which was a week ago, and I feel it requires further clarification, because I was saying that we go into this year, we're in this year, and the expectation from the Federal Reserve, something which the governors have been at odds and pain to emphasize, is they're like, we really don't want to do much. We've done it. We cut rates, like 100 basis points from September last year. So ideally, we'd like to just sit on our asses, if you will. And if you look at the rate expectations market, now it's called SOFR, the expectation.
What do the people at the Fed do every day? When they're not, if it's like this, when they're not doing anything, what do they do? What do they get paid for?
At most,
maybe Doge will get in there.
What, half of a quarter is nothing. Okay, and I was saying the last time when the expectation was that the Federal Reserve would be doing nothing was 2022, and that year was notable because they did a lot. Yeah, they're like, oh, we're done, we're done. Well, they raised interest rates 400 basis points. Yeah, almost a basis point for every PhD they employ, and so I feel like the most assured bet for the months ahead is that there'll be more than nothing that happens. There'll be quite a lot of activity, and here we are. I've been sitting on my roof terrace, cross-legged, meditating, trying to find it, and a lot's happened. We had that blowout non-farm payrolls. Now we have Trump. I mean, I feel like it's the end of McCarthyism. I feel like there was so much BS, and you had to keep you couldn't respond, and now it's over, and you can just, the entrepreneurs and business people, and you can speak again with wisdom without having to hightail whatever the expression is to nonsense. And not
you can be wise again. You're allowed to say things again. That's funny.
It's a nonsense. It's a nonsense statistic. The U.S. election says everything for the domestic labor condition. It's that it doesn't feel prosperous to the many, and hence the agitation for change, for any change. I mean, Trump's just like, well, when they look at the alternative, they're like, I will invest in anyone before I invest in the status quo. Okay, so give me the crazy guy until you guys start listening. So non-farm payrolls, blowout, subject to revision.
I do find it hilarious that like all the Democrats think whatever Trump is doing is crazy, and they're like, oh, now you regret your vote, now you fuck around, you find out, huh? And all the Trump supporters are like, this is exactly what we want. This is amazing. He's doing a great job.
We had inflation. We had an amazing inflation report, amazingly tame.
True.
I mean, amazing only versus the whipped up sense and miseducation, perhaps. We were talking before coming on camera about your miseducation in the dismal science of economics, and perhaps for sure we're going to discuss the miseducation and understanding, the misunderstanding of what inflation is, and then let me shut up by saying something simple, because I'm done with being profound. But I want to say this market is simple in terms of risk-taking market. I want to say that we've established, to use a nautical expression, we've established a plimsoll line, the graduation on a ship's hull, essentially showing load-bearing weight as it sits, as a tanker sits in the water.
He's talking about the line on the side of the boat that shows you how deep you're into the water.
That the plimsoll line is set at 5,700 on the most important index in the world. The supercarrier for all the world's wealth today is the S&P 500. And 5,700 is where it closed in the 24 hours following what was a shock when the Federal Reserve cut interest rates on the 17th, 18th of September of last year.
Mm-hmm.
And we're between 5 and 7% higher than that level today. And whilst the iceberg is uncomfortably close,
Mm-hmm.
you got to be fully committed to risk. You are risk accepting, okay? Until such time as the S&P were it to trade below the levels of September 17, 18. Now, is that witchcraft? Is that some silly nonsense? Quite possibly, but I import a great deal of significance to where the market trades cyclically when the Fed prints its first rate cut. And the price vis-a-vis that level kind of reveals everything. So whilst it's tenuous, we're only 5 to 7% above it. We are above it, and therefore we stay simple and we stay aligned and risk-seeking, but cognizant of the view that we might seek to lighten up should we fall below those levels. So I want to say it's simple.
I mean, I think you have a good point there. And by the way, for the listeners, we have been recording this prior to the Fed meeting. So we technically don't know what's going to happen over there. But in the sense that you say you need to take risk at this point, or risk acceptance, you need to have that. It's very straightforward, but it also starts to feel like we are in some sort of 1928, 1929 type of market at this point, that it can't go on like this. Just the same as the other day I saw that there were only 2 examples where the markets were pricing higher yields where the Fed started cutting, which was in 1998 and in 1928. So if those 2 are the prime examples of the markets that we're currently acting in, then we're just kind of...
If you missed that, that was a big moment. It was a couple weeks ago where the Fed lowered rates on the 10-year Treasury, but the rates on the 30-year Treasury went up, meaning that people didn't want to buy the 30-year Treasury unless it had a higher interest rate. So usually when the Fed lowers rates at the 10-year, the rates lower on the 30-year as well. But that means that the individual investors or, different governments, whoever buys 30-year Treasuries, they didn't have confidence that the interest rate that they were being offered would cover the inflation that would happen in the next 30 years. So they had to increase the interest rates to entice buyers to come and buy the 30-year Treasuries. So that was like a discrepancy, a split. That is a sign that there's something wrong in the market, and that was a big deal, and people were freaking out about that.
Of sailing across the world with Trump being our leader and saying, "Yo, we need to take risk, and everything is going to be fine." But underlying of that sort of run, there's a fundamental crash going to happen in the next 5 years. So it swings both ways. And there is a lot of volatility involved, and that also implies that there's more risk.
I mean, well done you. I'd love to say more than halfway through. I think in my head, I'm more than halfway through writing what for me could be a major paper, which plays on a lot of the themes that you've just mentioned there. I certainly would not wish to be cavalier.
So Hugh was saying, it's time for risk on. You have to accept you have to accept risk right now to be in the market. But then the interviewer was also saying, I understand that, but this discrepancy between the 10-year and the 30-year Treasury are signs that we saw in 1920s and 1980s. So this should be something, should we be risk off if we have that evidence in front of us? So it's kind of got what I would say, counterpointing evidence. Does that make sense?
Or light in this notion of risk taking. it terrifies me.
And risk taking meaning being in stocks,
Terrifies
being
me
in
at the best of
Bitcoin, like
times.
just
Like
not holding cash.
you should feel some terror at the consequences of being wrong. But we are in one of those very rare portals, one of those very rare windows in the history of the last 100 or so years of financial data where valuation is a concern. And there's much in the way of precedent that says that we are overestimating buy and hold, the return from buy and hold, that we have been very well remunerated the last few years. But at a starting point with these valuations, that you may do well to achieve 25% of the historic compound annual growth rate from stocks. So I'm very concerned about that. And more so with the overlay of my prejudice. And my prejudice is formed through seeking patterns with historical events. And I do keep coming back to two episodes, the late 1920s and the late 1990s. And I think they can be characterized as events when the Federal Reserve adjusted its policy rates with one significant eye on the overseas sector. And if you will, it took one eye off the domestic sector. Yeah. So if you will, it cut rates to alleviate pressure offshore. And in the two times that the Federal, it's only done it two times. And in those two instances, stock, the stock return was amplified into a bubble and subsequently into a catastrophic correction. And that's why procrastination and prediction at this point so early in the year seems like a crapshoot, because on the one hand, I know that we're coming into 2025 and we've had two consecutive...
So I think he was saying that twice in the history of the United States, in the late 1990s, late 1920s, the Federal Reserve wasn't so much watching the domestic market, but was watching the international market, and they cut rates because the international market needed it. And when they cut rates for the international market, they cut rates for the domestic market as well, obviously. But what that did was create a huge stock market bubble and then a stock market crash after that.
Years of 20% gains, more than 20% gains in the S&P. And that's rare. But at the same time, I can't preclude the notion that the Federal Reserve will cut if the situation deteriorates further offshore. And then with regard to historical pattern, there is the extraordinary period.
What people don't realize is that because the United States dollar is the global world reserve currency, other countries need the dollar. And they rely on America to produce more dollars for them because they need them, because we are the reserve. So America has a responsibility to get dollars out of the country into other countries' hands, into the global trade, so that dollars can flow because they're needed here. So I guess what he's mentioning right now is there may be a situation where the international markets are in such disarray that they need rate cuts, or they need dollars put out to support them, to bring them back. But maybe America doesn't need it at that time internally. And when they do that, it's going to pump America up and give us a stock market bubble like he's mentioned that happened twice before.
Between 1995 and 1999, when stock market returns were plus 20%, not for 2 years, but for 4 years. And now that's never happened before. And that was a function of, obviously, the Russian bond default and the Asian tiger economic crisis in Southeast Asia. And of course, LTCM, which was a casualty of all of that volatility.
So he knows so much about this shit.
The Federal Reserve was reducing
history of
interest
global
rates
trade and
almost
I don't
regardless
know
of
this
the
info.
very strong domestic conditions. And the positive momentum in the technology of the internet was bubble-fied. Yeah. So that's why I reduce it. So I'm cognizant of all of that. But to keep sane in this business, you got to keep something simple. And so I feel like that 5,700 is going to be how I stop having gray hair, and is how I'm going to retain some notion of responsiveness and alertness to both the opportunities and the dangers.
Well, I need something because I'm turning gray, but I guess that we just discussed it prior to our conversation. Being in the crypto markets for 8 years is like 80 years in the stock markets. It's just trading on steroids. But I think if you look at the markets nowadays, then it feels like we're creating some sort of chip or tech or AI bubble anyways, where all the tech companies are just having significant returns over the past years. Of course, 2022 was disastrous for instance, Meta and all those other tech companies, but that was also due to the fact that the Fed was raising its interest rates, so then tech companies become more expensive. But similarly to your examples, China has almost defaulted anyways.
It's always defaulted on what?
Well, if you look at the real estate markets in China, they have been going down like 50%. The stock markets are doing bad. China just announced the past months that they have the largest QE packages taking place to just stimulate the economy, primarily due to the reason that they didn't have any COVID stimulus, so they need to activate the economy again. But China is having its issues, while US pretends to be the strong player in the markets at this point, while the US is actually the weak one of the two. So is the fact that China is currently the one having issues, the fact that the dollar just continues to stay strong and the yields go up and we live in some sort of fake Fugazi land that everything is fine?
Did you say the US is the weak player?
Well, not yet. Right now it's no. Right now it's still the strong one, but it can't just like I say that because if you look at the domestic economy or if you look at what's happening with Trump.
I mean, I got to say, I don't understand the macroeconomics as well as these guys. Definitely not even close. But I'm expecting the collapse of the United States. But now with Trump in, now with what Doge is doing, and if Doge can find billions and billions of dollars or even trillions of dollars of waste and corruption and cut that out, like I get a lot more confidence in the dollar and the length that America can continue to be the global empire. You know, maybe we get another 100 years if we keeping the dollar as the world reserve, if they can clear up all this corruption.
Being such a big winner.
So I don't see weakness in the States right now. I see strength.
In essence, it's just naturally not a great outcome of the elections, which is in line with the right parties winning in Europe, which we've seen quite often in our history as well. It's not always a positive signal for happiness in the society, right?
I mean, it would be very gripping if my voice changes, if the microphone has jumped, because
I want to get same now.
Okay, but I want to get serious. Let's see if the last few weeks haven't been an absolute car crash for me, and I've actually learned something. What I want to say, I want to draw you a picture of perhaps analogy with the 1920s. Mm-hmm. And if we were putting a chapter heading on this would be the death of money. I've had this presumption that the money dies every 100 years. Here we are, we're 2025, and we're like 100 years removed from the events that I'm going to draw upon. And in 1930, we saw effectively the end of the gold standard, which was a death of money event. Okay, so, and I'm going to I'm going to focus on the UK for several reasons. The UK back then made a catastrophic decision.
I assume he's talking about 1930s.
To repeg the British pound to the gold at the same level as the pre-First World War level. And it did so in 1925. Now, the war, of course, had raised the price. War is many things, but it's a supply shock.
Mm-hmm.
And it had, it was like an elephant passing through a cobra. Prices, boom, they didn't go down. Prices just become elevated, yeah. And so domestic British sterling prices were way higher than the level which preceded the First World War. But by establishing the standard at that level, you were committing the economy to disinflation, to deflation. You had to bring the price level back down, which was profoundly foolish and profoundly...
Wait, so after the war, the UK pegged the pound back to the original peg for gold, I guess? I don't know what the original peg was, so I can't give you that information, but I think is what he's saying. So the pound was pegged to gold, to a gold ounce, and then I guess it got depegged during the war, and then went back to the war, went back to the same peg as before.
Painful.
Even though prices have inflated.
The British population. Okay.
This I don't understand.
Now, let's think of the foreign exchange markets. And I'm Japanese, French, American, German, whatever, okay? There's a huge risk if I hold sterling, there's a huge risk that the British government will not be able to lower the domestic price level to its pre-First World War level. And failure will result in a currency devaluation. So the devaluation is the predominant risk. And so as a currency speculator or just...
Okay, if you're getting that. So if they pegged it back to the original gold ratio, then they got to bring the prices down back to where they were before. So if you're a currency trader, you're an investor, you have the risk that they can't bring those prices down. And if they can't bring those prices down, if they can't reach it, they have to readjust their currency valuation. So you're going to be screwed during that readjustment process. So why would you hold the sterling or sterling?
Anyone involved in currency trading, I demand a huge risk premium. And so if we go back to that time, British sterling rates were the same level as they are today, 5%. And 5% was not appropriate for the domestic condition in the UK. The UK was, there was no economic growth. Okay? But you had to pay 5, the Bank of England had to set 5 to kind of, not to trap, but to persuade people to hold the currency and to stop domestic institutions and their savings transferring abroad. Now, domestic savings, they leaked out of the UK because whilst you could get 5 at the bank, you could get 55%, if you will, lending. Essentially back then we had something which was similar to today's euro-dollar system. We had an offshore unregulated banking sector, which lent to financial speculators, which is to say that you could take your pool of money and you could lend it to people who wanted to. They would use their stock portfolios collateral. They say, hey, listen, I've got $1 million. I'm invested in the Dow Jones, and I'm going to pledge that to you, Mr. British Bank or Mr. British Pension Fund or Mr. British very rich person. I'm going to pledge you my portfolio. Well, but I need more money. What will you give me? And they're like, wow, yeah, we'll give you $1 million. Yeah. And so suddenly the stock speculator had $2 million invested. Yeah. And so that between 1927 and 1929, stocks just again bubbled. Yeah. 27, 28, 29, boom. And so whilst you were getting 5%, and that was killing the British economy, money was still leaving the UK and going into America. Okay. And all of this was a function of that we had had a war, and the British domestic price level had...
Pretty interesting. I never knew about any of this shit. This is not what I was curious about when I was younger, but now I find it pretty interesting. And it's we got a similar cycle going on again on the state side.
There had been a phased and substantial increase in all prices. Okay? And that had led to the impoverishment of the household sector, because what is meant to happen is when the price of, I don't know, bread, when the price of essential elements in the household budget rises by 10, 15, 20%, then it may take a year or two, but actually wages increase by a commensurate level, and you're no longer impoverished, that you can maintain your consumption. But that could not happen in the 1920s because of the strictures of the gold standard. It was an austere system which would not provide for wages rising to compensate for the impoverishment of the higher prices. Okay? So the UK was a tinderbox, and we came close to a Bolshevik revolution. Okay? And I want to compare that to today. And I'm focusing on the UK because it's the same applies for France, and more so. But the French are within the Euro system, right? And so all the pressure is diffused. That the euro is this substantial, kind of equivalent to the US dollar as collateral, very, very, very liquid, and people are willing to accept European bonds almost as being proxies for dollar bonds. They are not willing to accept a 10-year gilt as being dollar equivalent to a US Treasury. Yeah? So the UK was different in the 1920s because it went back onto the gold standard, and it's different today because it's not within the currency regime of the euro. Okay? And so it's more vulnerable, and therefore it's worth discussing. Mm-hmm. Now, we've had no world war, thankfully, but we had something which was almost as expensive.
Yeah, this is a little heady. A little heady. I like crypto so much. This is a little hard, but okay.
Which was the pandemic.
I learned.
And the pandemic years of 2021, 22 led to, again, a phased, stepped increase in prices, in all prices. And owing to your education, you want to call that inflation. But it's not inflation. It is the impoverishment. It is the devaluation of the labor class. Okay? Because, and why? Because back then we had the gold standard. Today we have something very, very similar and very, very austere in the control of the global labor market, which is the Chinese US dollar exchange rate. Okay? And because of that, and that rate, so that the rate which determines transactions between the two largest economic blocks in the world is not a market-determined rate. It is a rate determined by bureaucrats and bureaucrats that are generating $1 trillion a year from a trade surplus. And the $1 trillion makes them seem like geniuses, and they've been able to get away with the determination of a false market. Okay? Now, so with COVID,
that went above my head. I don't understand
the impoverishment. Okay, it's impoverishment because
the trade rate between China and the United States is similar to backing to gold. Please elaborate.
British
Hugh.
wages.
Please let me understand.
And as you know, like all wages, but we're concentrating just on Britain. British wages have not risen commensurate with the price spike of COVID.
Okay.
And so people don't feel good.
Right.
And if you will, there's a huge risk in owning sterling. There's a huge devaluation risk because they're trying to trade. They're trying to pretend that prices haven't jumped by 20%. And everyone's like, I need 5% before I touch your currency. And of course, 5%, Bank of England are meeting today. They might, the Bank of England is now the most hawkish. What is most hawkish? It's the most hawkish central bank in the world. Going into today, Bank of England rates were 4.75%. So that's probably the highest of the developed world. Is it hawkish or is it they have no choice? It's surrender. Like they are having to bribe you 4.75 to hold the currency. There's such a huge risk of devaluation in sterling.
Okay, if you're not understanding, I'll do my best here. Because because Britain is not in the euro system and it's not in the American dollar system, their currency has to stand on its own. It has to fight in the global trade. So because no one wants to hold it, they have to increase the rates. And what's he saying? They're offering 4.7. Is that what he's saying? Not because like that they gave up. They have no choice now. They need you to invest in their treasuries and their bonds. So they have to offer this higher rate, which means they have to pay out more money, which means the country's going to suffer more. Yeah.
And yet, the domestic savings institutions, they're like fleeing. What are they doing? They're buying NVIDIA. They're buying Microsoft. They're buying the Mag 7. And so it just feels like the 1920s. And my only point, I can't tell you, the really dumb thing is, I can't tell you if it's 1927 or 1929, but I can tell you that in 1931, the UK came off the gold standard and it devalued by 25%. It went from like almost 5 to the dollar to 3 to the dollar. And that resulted in the death of money. And so I feel confident in telling you that the same thing is going to happen, but the currency involved will be the Chinese. And coming back again and again, thank you, because you mentioned so many points which are in my head. The Chinese have not, I don't think they have officially announced a policy of quantitative easing.
No, they don't call it like that.
Which is buying their domestic treasury assets. But clearly they are. And so I have another supposition for you. And forgive me, this is quite a rant. I did warn you. Everyone believes that the Fed is your friend. Like, that there's a put option. You can put it back to the Fed. The Fed will bail you out. The Fed is the friend of the stock market. I don't believe that's true. I believe that the incredible return from US risk assets is a function of the malaise and the corruption of the dollar renminbi rate. Yeah? That in order to maintain the external price of the Chinese currency, the Chinese had to put all of their spare resource into the risk-free US bonds. And in doing so, they inflated. We live in a world where everything is overvalued. And it's overvalued to maintain an overvalued exchange rate. Okay? Or an undervalued exchange, depends on which side. But you have the overvaluation of everything to maintain the fantasy that one red cabbage or one renminbi, seven renminbi is worth $1 US. Okay? And what I think may be happening is that we're getting a regime shift. That the Chinese are going, we have so royally screwed up, like property disintegration, a stock.
Okay, still trying to understand this, still trying to follow. I think he's saying that China is basically UK in the 1928 in that example. That the Chinese currency is about to be devalued. Why? I still don't understand. Hopefully I'll figure that out soon.
Market, which is on its ass, trades at the same levels as the start of this century.
Mm-hmm.
And they've announced policy bazookas, and stocks went down. And they're like, oh, what the heck? Yeah. And so I think what's happening is rather than target the external price of China, the bureaucrats now are very focused on the internal price of Chinese assets. And so all of their flow will be directed internally. And so what you're going to find is the death of money. Like, can I just say to you that since 1982, the S&P has risen. How many?
I think he said that this is kind of this interesting thing that governments have to deal with, or banks deal with, the international demand, the international markets and the domestic. That if the domestic properties are falling in China, that we're going to see the Chinese bankers and Chinese government, instead of putting their money out into the global market, like buying treasuries, US treasuries, they're going to be putting that money in and holding up the price of domestic assets. I think that's what he said.
Here's a test. Okay, just make up a number. How many times has the S&P gone up since 1982?
In terms of years?
No. I mean,
in terms of multiple
43
times.
years. I mean, 42 years. But if it was 100 in 1980, which it kind of, well, I'm giving it away, but how many? Like, has it gone up 10 times?
Close
50?
to it. Close to it, or maybe even more. Yeah, I think it is 7 or 8 times.
7 or 8. Okay, so the
Wrong.
The right answer, albeit it's friggin' crazy, is it's gone up 60 times. 60 times. Okay?
But that is not economic growth. That is primarily due to the fact.
Exactly. So what I'm saying to you is, I said 1982, 12 years later, you find yourself in 1994. It's remarkable. I can add 12 to 84, to 82 rather. What happened in 1994? The Chinese devalued their currency when the US, Mexico, and Canada came together under the NAFTA. Okay, and so since 1994, the Chinese have been maintaining a false market in their exchange rate, and they've been an endless money printer, which has gone into US assets. Yeah. And I'm saying to you, it's over, baby. It's done. What China seems to be doing now, they are determined to get, the yield on 10-year Chinese bonds, government bonds, is presently 1.6%. When they announced their bazooka October last year, it was 2.2, 2.25. So it's fallen 60 basis points. And it seems they want to get it down to 50 basis points. They want the return on 10-year Chinese government bonds to be so profoundly shit, like really unrewarding, that as a domestic saver, you will put your money in stocks and property. Because China now needs domestic collateral to underwrite future years of economic prosperity.
Okay. All right. I got that point at least. So the Chinese market, Chinese banks are reducing the rates that they're offering on the treasuries. He was mentioning the 10-year treasury going from, I think he misspoke, but going from like 2% down to 1%. And the ultimate goal is to get it down to like a 0.5%. So basically you're getting freaking nothing. So nobody will want to hold the treasuries. And if you're a Chinese citizen and you cannot get money out of the country, you are trapped economically inside of the Chinese borders, then your only solution is to go risk on, and is to invest into real estate, invest into stocks, invest into the market, invest domestically into the country. So the Chinese government is kind of forcing their citizens to forcing their citizens to invest any savings they have into domestic assets. So that's interesting. But what that means too is that the at least for the Chinese government, if they're not investing in U.S. Treasuries too, the U.S. Treasury rates are going to fall, or the rates are going to go up, but the price is going to go down.
So I'm saying to you, I have sat on my roof terrace in the French Caribbean for 1 month, and either I have baked my brain or I have seen the future. And in this year, when the experts tell you that the Fed's going to do nothing, the Fed's going to do a hell of a lot, because we are about to witness the death of modern money. Boom, we're finished, we're done.
You know, it's quite annoying when you're so in line with the guest in terms of expectations that it's always quite like hard to ask questions. But I think that you're touching, like for me as a younger trader, investor, it's sometimes hard to connect the dots. And I think you have been touching upon those points really, really well up there. I think China is going to have a big impact. But if we say that China is constantly pushing money towards the US, what is like, when is the time going to be that it's going to shift? And when it shifts, it's going to be a disaster for the US and probably for parts of Europe. What is that trigger going to be? As in, China has been doing those positive impacts into their internal economy, has zero impact. So probably they will continue to raise that.
Oh no, this is, I believe this is quite straightforward. China has been pursuing its own self-interest. And it's the self-interest of the Chinese Communist Party. It is a fascist, undemocratic state. Now, lovely people, but they have been bribed with prosperity to look the other way. And so the policy, the foreign exchange policy, the undervaluation, the pursuit of economic growth externally via the export sector will be supported for as long as it maintains the objective of at least 5% economic growth domestically in China. When that fails, they will give it up in pursuit of a policy which is better suited to the achievement of something which is impossible anyway. Okay, so, and I think that...
Okay, I get it. So the interviewer was just asking, like, when is China going to stop investing the money into the global markets, into America, into Europe? And he was just saying, once the domestic growth of China dips below 5% GDP, then that'll be the signal for the Chinese government to move forward with this plan of just basically shutting off all the money leaving the country and going back into pumping up the domestic market so they can keep that 5% GDP, which in turn is going to mean all this money doesn't go into the West. So that is going to be huge hits for the West. I wish he had data on that. I don't know how much money flows from China to the States and to Europe. And I don't know what the GDP growth rate right now of China is
what
either.
We're seeing.
Can I find out? Let me look.
Yeah, we've seen them in the last 4 months. Their policy announcements show their concern that their projections are most unlikely to be met. What we're seeing in the 10-year Chinese bond.
And right now they're saying that 2024, the GDP growth was around 5%, 5.54%. So they're in there. They're hitting their numbers, or at least they're claiming to hit the numbers.
Demonstrates vividly that the government is involved. Now, the next point is, so most likely with everything with Trump is an exaggeration. So there's going to be 50% tariff on everything from China. And now maybe it's 5% or maybe it's 0.5%, you know. Yep.
Or nothing, whatever.
Or nothing. But there were tariffs imposed under Trump 1, which the Democrats retained. And they are essentially, they are deflationary. So people again say they're inflation. So again, let's go back. Let's say Trump is true to his word and he puts on a 50% tariff, okay? So what that means is the price of, I'm Walmart and I import, I don't know, $100 billion of Chinese product a year. And I'm going to have to, that $100 billion is now going to cost me $150 billion. And so my prices are I'm going to add that to the price on Amazon. And so again, with the dismal science of economics, we say, oh, inflation. But it's not. That is actually impoverishment. Because US wages ain't going to rise by 50%.
Mm-hmm.
Yeah. And so, again, you're going to get this malaise and people are going to get frustrated and they're going to keep electing kind of, provocateurs who are sympathetic to their anger. It's not inflationary until you break with the Chinese break via the currency. There is a notion that now with the tariffs. So I'm not demonstrating this very well, but there is a very valid argument that any tariff can be circumvented by the Chinese by devaluing their currency.
Yeah.
And I don't dismiss that. That's very true. But it's deflationary. It's not inflationary. The economics of devaluing an undervalued exchange rate. So again, forgive me, would you agree that the Chinese renminbi seems to be undervalued vis-a-vis the US dollar not on a political basis, but on an economic basis? Would you agree with that statement?
I think, well, first of all, I'm not the biggest Forex exchange expert, but I think so, yes.
Yeah, and the evidence...
I have no idea, but I know if Hugh framed that question to me like that, I would say, yeah. But I have no idea if the Chinese RMB is undervalued compared to the US dollar. So one thing that he's saying or other people have said is that the Chinese can get away from the tariffs by devaluing their own currency. So if the product costs, I guess if it costs 100 RMB, and then we are putting a 25% tariff, so it would cost 125 RMB, they devalue their currency. So originally it would cost what? Then it would be like 80 RMB, and then at the 25% tariff, we're back up to 100, around that area.
Would be that their trade surplus with the rest of the world is in excess of 1% of global GDP.
Mm-hmm.
And we have 150 years of data, and that's like 1929, it's like 1999, right? It's an extreme event that is very rare for any nation to have a surplus of 1% of global GDP. So it's very rare. And therefore, the supposition is the exchange rate must be undervalued. So if you devalue an undervalued exchange rate, nothing good happens. Why? Because your economic neighbors, they say, hey, get out of here. Like, you're killing us already, and now you've just had a competitive devaluation against us? No way. So the benefit from your exports is almost zero.
I do not understand.
Mm-hmm.
And you're hoping to gain more from exports because
I guess you're making Chinese,
if you
would make Chinese products even cheaper. So then the other countries are pissed at you because they can't even compete with the cheap Chinese products already. I think that's what he's saying.
Then the cost of everything you import has gone up. And your household sector, they're not getting wage increases. And so again, they're impoverished. This is a really, really bad situation. So I look at, again, the frustration is, I can see the future. But when I look,
Can't pinpoint it.
yeah, I do these dream manifestations and I see it all clear, and then I wake up and I'm like, I'm trying to rub it gets a little bit opaque. Which year? But I'm sure this year is very, very close. Um, but maybe we get 2 more back-to-back incredible S&P years, or maybe the thing blows. But I think that holds the two together is, and to make it practical for investors, is I'd be looking for an ETF, an American ETF that gave you exposure to the SOFR contracts, for the interest rate contracts for essentially where the Fed will be. So December and all the way out to June 26, you can buy those contracts around 96. And to let people understand the significance of 96, is bounded at 100. Where it's essentially 100 would be zero Fed funds rates. And the likelihood that America can go to negative rates, I wouldn't say it's impossible, but it's deemed to be less possible than than Europe, owing to the huge scale of money market funds. So the notion is, and you get a lot of leverage in those contracts, and you can buy options on those contracts. And if you're buying options, you've got to be selling options. So you would want to essentially create an option package that said that the SOFR between December of this year and June of next year would trade above 98. Yeah, so you'd be kind of, if you will, because it's options, you've got to sell something, because options are always expensive. So sell something to buy something kind of allows you to take out the price premium in options. But you essentially want exposure to the notion of actual Fed funds rates being 2 or less than 2% between the end of this year and the middle of next year. That in itself, that will happen because they're bailing out the rest of the world, and it makes a bubble in U.S. stocks, or that.
All right, so he's just offered some trade. I guess he can offer trade advice because he is a manager, although I don't know if he's still has his licenses or whatever. But anyway, some ETF, I never heard of this ETF, but you can bet with or against the federal funds rate, the interest rate that they set. So if it's at 100, the interest rate is going to be 0. And I assume 98 would be 2%. I guess that's what he's saying. So he's assuming that the Fed rates are going to come down. Then you could buy options on those contracts to try to get to a point around 98. Right now they're sitting at 96, or they're selling for 96. So you could try to assume that they're going to get to 98 and buy options for that. I think that's what he's saying.
The whole world just tips on its
hard for me to follow.
Its ass and falls over. So I find the most comfort there. So again, all this job owning and fancy talk and nonsense, cutting to the chase, this 2025 could be quite a straightforward year. I'm positioned, we haven't mentioned it yet, but digitally, I find the only asset which has risk asset which has profound asymmetry to the upside is Bitcoin. I'm sure you'll be delighted to hear that.
I am delighted to hear that.
I've got an exposure there.
I've never heard Hugh talk about Bitcoin before, so I am ecstatic to hear that.
To a surprise. And my big surprise is rates. Rates are going to move a lot, and this is going to be a big deflationary year. And so I'm putting the two together, and I'm like, and as long as the S&P trades above 5,700, the games and the merriment are going to continue. But you watch, if we lose 5,700, then things will become quickly more deflationary, and asset prices could be subject to quite a substantial devaluation. Boom.
I think we are going to talk about Bitcoin for sure. I think you have been I think you have been talking about this on a previous podcast late in 2024 too. So we're going to talk about that. But I wanted to touch upon a few other topics before, which is
Perfect.
there was one occasion in 2024 that the market significantly dropped on either a crypto or the stock markets, which was when the Bank of Japan did its rate hike, given the fact that we have the Japanese yen carry trade. Earlier this week, or actually last week, they announced another rate hike and they continue to do so. What's the impact of that?
Again, bravo, well done. Because I should have mentioned Japan. It's very complementary.
It's kind of the similar trade, right? You borrow money in Japan, you invest it in the US, everything is great.
Yeah. But
Simple words.
It's very similar to my discussion about the UK.
Yeah.
So 1931. Sorry to bore people. They're like, "Oh, stop going back."
I mean,
Don't mention the war.
I mention 1928 and 1929 quite often on my other YouTube channel because I see a lot of similarities with that period and the current period. And the fact is that people won't understand what will happen in these years because they don't look at those years. There's nobody from that period alive anymore, but there are so many similarities taking place that you can actually learn from it and take relatively wise decisions. So I would like you to continue talking about those years. That's really good.
Well, thank you. And I promise you, I was not alive.
Who knows?
Albeit, I'd like to think I'm going to be alive in 2120. With
So I said earlier before, I learned not a lot because it was just super complicated, but I learned about the central banks and the yen and the trade that occurred many years ago. If you want to see that documentary, the documentary is called Princes of the Yen. You can find it on YouTube. It's an hour and a half long. It is heavy. Be prepared for that. I mean, this is kind of a similar sort of energy vibe to this interview we're watching right now. So if this is way over your head, that's going to be way over your head. And you might have to watch it a few times to understand it. But it was made by this Richard Werner's German economist. It's pretty good, interesting, hard to follow. But I mean, this information is valuable to have. It's good. If you're in the markets, it's good to learn about the markets and the history of them.
AI, and can I just say to people, if you live in a hot climate, or indeed consider adopting a pot plant. I have. I'm sure you won't use this, but I have become.
Oh, I got frozen. Too much stuff going on my computer. Come on, computer, you can handle it. I believe in you. Come back to me. Come back to me, sweet computer. Technical difficulties. I promise I won't do that again. I won't open any more tabs, I promise. Right when Hugh starts talking about growing a pot plant, YouTube shuts us down. Come on. Come on. Uh-oh. You here for me? What are you doing? Okay.
Standard.
There we go.
I've had this presumption that.
Oh no.
I've had this presumption. And you're. Boom.
I think Japanese. Yeah.
But
simple words.
We're back.
It's very similar to my discussion about the UK.
Yeah.
So 1931. Sorry to bore people. They're like, oh, I use it as a moisturizer.
I was just
consider adopting a pot plant. I have. I'm sure you won't use this, but I have become. I've discovered a miracle, which is the aloe vera cacti, and it grows like a weed. I'm here in St. Bart's, and I drink it. It's amazing for your gut. I put it in my hair. I use it as a moisturizer. I cover my body. I am literally covered in aloe vera. Remarkable product, and far better for longevity and everything else, owing to its natural properties. Grow it. Don't buy chemicals out of the supermarket. Anyway, 1931. An event of profound historical significance. The UK finally came off the gold standard. I mentioned this earlier. And the currency fell 25% vis-a-vis the US dollar. But it's a big deal. Okay. Since August, I think it's 2021, the Japanese yen has devalued 25% versus the US dollar. Yeah. It is mind-blowing. Like, so for people of my generation, born in the 19th century or something, we've never seen. We've had a devaluation in the yen. Now, people take succor like a dummy tit. They take succor on logicality, and they say, but that's because the US is at 5 with its inflation, and Japan's at 0, and the US is going to come from 5 back down to 0, and so it's just it's an aberration. And again, what that lends itself is this notion that all these currencies, except the dollar, have a devaluation risk, and so they have to have higher and higher interest rates to protect you from the devaluation risk. And so not only has the yen fallen 25%, but the authorities there are saying, heck, we better start raising interest rates or our currency is going to devalue more. Now, more than 25 is, you're going into this chapter that I call the death.
Yo, it sucks if you're not on the dollar, man. If you're not an American, or if you're at the Federal Reserve and you get to use dollars, you're another country trying to survive. That sucks.
Of money. The yen should not be falling 25%. That is off the charts in terms of negative significance. And they raised rates in July from nothing to nothing, yeah? And that was enough to set off like a 12% correction in global equities. And within that, there was some really, really big declines. And then shortly
it was like... Ethereum went down 40% in like 3 days.
Wow.
Bitcoin went down 25% based on that trade.
Yeah. And 3-4 weeks, not even.
And I think Japan raised it by a quarter of a percent. It was super small.
Well, they've just, again, everything seems to have happened since I decided not to make any comments. And Japan has raised its interest rates again. And what has the currency done? Currency's done fat zero. Okay, so why is the yen why is it not?
It's so weird. I always think of Japan being an expensive place, but now if you live in the States or you get paid dollars, you try to go to Japan, you can get like a nice lunch for $3, $4. It's like you're traveling somewhere in Southeast Asia. Like now it becomes like a cheap place to travel. It's wild.
Why is it not appreciating? It's not appreciating because the promise by the Bank of Japan to keep raising interest rates is baloney. Like people like me, we're like, I don't believe you. I do not believe you. Yeah. Because so in that environment, we've seen this with all the hiking cycles. The Japanese curve is steep, which is to say the 10 years, like 1.2, the 2 years, 70 basis points, steep in Japanese terms, yeah. And if you're going to hike rates, and supposedly they're hiking rates to control inflation, then you're going to hike rates and flatten your curve.
Mm-hmm.
So you're going to take Japanese rates to 1.25. But what you start to discover is a bit like in the US, where the budget deficit is 6.3% of GDP in a booming economy, because the debt service is now enormous, right? Now the US has got 1 times debt to GDP. Japan is like 2.3, 2.4 times debt to GDP.
Wow.
Once you start repricing your short-term rates and dragging up the curve, and you're refinancing all the debt that works off, you are in this world of fiscal dominance where you don't have the GDP growth to support where your interest rates are trading.
Okay, so he's saying like that Japan says they're going to keep raising their interest rates, and he's calling bullshit on that. So if you raise your interest rates on the short term, then the long term the rates are going to go up as well. But Japan's GDP is what, 1 to 2, like the ratio is 1 GDP to 2 something to debt. So if they're raising their interest rates on the recent treasuries, once everything gets repriced, they're going to owe so much in interest for all the debt that they have accrued, that they won't be able to afford it, that they cannot continue raising the interest rates. They just can't afford to do it.
You are rapidly going to become a sovereign insolvency case, in which case your currency is going to trade 200, 250, 300. So Japan is in a very precarious situation because they are trying to preserve their currency by kind of...
I'm seeing Japan, you can buy a house for like $20,000, $15,000, like an hour outside of Tokyo. Maybe in 2 or 3 years, we can buy one for $2,000 or $3,000.
Promising to do the impossible with interest
and I'm
rates.
buying a house.
They can't raise interest rates because raising interest rates will tip the balance of expectation. People will focus on government debt and say, you, my friends, are going to become insolvent like that, and your currency's toast. So again, we come back to a world where the Japanese are secretly praying that their currency can stay at 155 versus the US dollar until such time as the Fed brings interest rates to 2% or less. And they think under that world, they're saved. That's how I would explain Japan. And again, that lends itself into why I like those SOFR contracts. And again, it explains how it's so difficult to determine whether the stock market either goes up a lot more or goes down a lot more, because we're at a pivot point and only time will reveal what the Federal Reserve will do.
Yeah, and I think it's a good last few words where I think all those factors take into account on how markets are moving for sure, but we also have an internal debate in the US currently, which is Trump wants to lower the interest rates. He probably understands the dynamic. And Mr. Jay Powell wants to remain his hawkish stance, have a very tiny framework in which unemployment and GDP and everything needs to stick into in order to avoid doing any rate cuts. Actually, the topic is going to be to do additional rate hikes, which I find quite foolish. But is Trump going to have any impact on the Fed decisions? And if that is the case, like if the Fed is going to announce a rate cut in this meeting or next meeting, then the topic of the media will probably be it's because of Trump. And if that is the case, it will put additional uncertainty on a lot of things within the economy. So my question is probably, is Trump going to have that influence, or is it independent and they will frame him that he has been putting some pressure on Jerome Powell?
Well, Trump certainly is adding to the risk premium. You know, if you're going to own 10-year treasuries, you're probably holding off for higher yields because you need a greater expected return in order to deal with the hurricane, which is the mouth of Trump.
That's true, yeah.
So let's see if we can discuss a few things. First of all, there's an observation, which, heavens, my mind's gone blank, but what is the name of the very misfortunate hedge fund manager that I always talk about, with the funny name? The guy, he was an ex-Soros kind of trader. Niederhofer, forgive me. I've invented a rule called the Niederhofer Rule of 5. And he is a kind of a preposterously volatile character. I was reading, there's a wonderful article about his career in the New Yorker, which I'd recommend to everyone, much better than reading his book. But it finds him in 2007, and the 10-year Treasury bond yield hits 5%, 5.1, and he shorts the S&P, and he shorts the S&P in a preposterously large size. And his argument is that 5% is a very, very appealing return that at the margin will persuade people to sell equities and buy bonds, whatever. Okay, and it just made me look at that level, and what you see is that in this century, in the 21st century, the number of observations where the 10-year Treasury yield has traded 5 or greater are remarkably few. Mm-hmm. Like, you were in the 25th year of this century, and since 2007, I think there have been no more than 24 days where you've had yields greater than 5%. I mean, check it. Okay.
Probably last year, I know.
Last year, we got there. We got there actually. Not last year. We got there October 23, which was
true.
It was the lows peak of the stock market, and then we kind of got to these levels in April of last year, and now we've round tripped again back to these levels. Okay, and so I believe presently that whenever the 10-year is around about 5%, that actually I want to own fixed income, or I want to be taking contract risk with Fed easing. That's my notion. So I feel that we're in an environment where I don't see it. I don't see something has to change fundamentally within the landscape for bond yields, for U.S. Treasury bond yields to trade 5.56, 6.57. Okay. Now, that could happen. Certainly, that could happen if Trump were to fire the Fed, and he were to take away their independence, and he were to set interest rates at 0%. I presume. Mm-hmm. I presume that there would be a huge tantrum in the fixed income markets, and they would sell off bonds. They would say, "Oh my God, this is crazy." Okay, but I don't think that's going to happen. There's another observation, which is that anyone that's been involved in emerging markets,
that interviewer reminds me of Napoleon Dynamite a little bit. If he pulls out a nugget or a hash, what's it called? A tater tot from his pocket, I would crack up.
40 years. And
please have a tater tot in your pocket.
Emerging markets are a myth, right? Again, a myth, or emerging markets are the trap of logic.
If you missed that last part, it was just that that having interest rates at 5% is so rare that occurs. So if we get to that point, it's in his mind, a good place to be shorting that kind of interest rate, or making your bets to assume that those interest rates are going to come down. That'd be very unlikely that we're going to push 5.5%, 6%, unless they give that example that Trump gave, or Trump does something intense, and he could.
Logicality.
So we'll see.
Like, it's very easy
but 5%
to resonate
is a good number
with,
for
their GDP
like
is much faster than the Netherlands, the UK, France. So it makes sense. I'm going to buy their equities. because their equities are going to go up a lot more. And they never do. I mean, periodically, but over like 5, 10, 15, 20, 25, they don't do it. And the reason is that they have a very poor form of contract law, and that the insiders siphon all the gains. You as the external minority shareholder, you get shafted. And then on top of that, you have this macroeconomic mismanagement. And so I mentioned to you that in 1997, 1998, we had Thailand. Thailand blew up. My friend Victor Niederhofer, I mean, he just discovered stocks in Thailand, and he'd bought way too many Thai stock futures. And then people like, foreign investors started pooling their money, and the whole thing fell apart. Okay. So what I want to say is America increasingly looks like an emerging market in terms of the macroeconomic risk, that the symptom of an emerging market crisis is a malaise in the price of the 10-year government security.
A malaise?
Right? So the 10-year government security, it does keep going back to 5%. Inflation categorically looks as though it's coming down to 2%. I mean, it has proven optically higher owing to the artificial construction of the homeowners' rent calculation in the inflation. That's a lagging indicator, and that lagging indicator we can now see in the months that follow is coming down. Mm-hmm. Housing is just not affordable with regard to where mortgage rates are, and so it's coming down. So why are US Treasuries yielding 5%, and why do the great investment legends like Druckenmiller, they're short? They're saying they're going to 6%, they're going to 7%. That kind of feels spookily like emerging markets. And so again, remember I said to you that the crisis in emerging markets is they've been pumped up by overseas money coming in and pushing asset prices higher. Money comes in, asset prices go higher. Money comes in, asset prices go higher, yeah?
Yeah.
And actually, that's America since 1994 to maintain the artificial exchange rate, the non-market derived exchange rate between the renminbi and the US dollar. All of the trade dollars that China receives, they've gone in to American capital markets and propelled American capital markets higher, 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 higher. Now, what is happening is distress now in China means that they've been selling the treasuries. So I think the 5% yield, I think it's got more to do with the change in the monetary regime in China. Mm-hmm. And the change in the...
He's just saying that America is from a macro view, is appearing or playing like an emerging market. And that it's basically been an emerging market since the beginning. It's just a gigantic one. So that outside money comes into this market, pumps up all of the assets, but then eventually the outside money leaves and all the asset prices die and get depreciated. But maybe America is just like the biggest emerging market.
Monetary regime in China, I fear that has more negative implications for the stock market than the bond market. And so I actually think, and this is, I mean, if I haven't lost you yet, I'm really going to lose you. But so
I'm trying.
I believe in theater and drama. Okay. Mm-hmm. And so big things happen and we don't see it because we're attuned to being linear and logical. And yeah, like crazy shit happens. You know the psychological test. It's in an office in front of an elevator shaft. The door of the elevator keeps opening, people coming in, coming out. But there's some kids and they're playing basketball. They're passing the ball. There's the blue team and the white bibs. And your challenge is how many times does the blue team pass the ball? And you're like, no, you really, really concentrate because we're investing. We're really, really concentrating. And you're like, and you go, how many times? And it's like, yeah, 15 times. You sure? Yeah, I'm sure. Anything else? Nope, 15. And you're like, okay, well, what about the gorilla? Yeah, what gorilla? And you watch it again, without that manic attention, and you see that a guy comes out of the elevator wearing a gorilla suit. He goes like that, and but you never see it. You never see it because you're too busy talking about AI, talking about bond yields, I don't know, like too busy concentrating. That's the great blindness that we have. Anyway, I believe that the enormous bull market in bonds is approaching its end.
Yeah, I agree for sure.
Okay. But it will end with a drama that no one could foresee except crazy people like me, right? My challenge to you is I think the 10-year US Treasury could approach the price highs or the yield lows of 2020, 2021.
You think so?
And yeah, because I can see so much deflationary events happening. I can see the death of money. And the first response to the death of money, volatility will go crazy on the upside. You will crush risk assets. And you will have to own, initially, you will make money on treasuries.
Mm-hmm.
And somewhere between that point, between now and that point, I will want to short the hell out of treasuries, because when you kill the gold standard and when you kill the dollar renminbi rate, you're killing money and you're unanchoring money. And I don't want to own a 10-year or 30-year government security at that point. So, crazy times.
It's good that you're mentioning, I think that's also...
If you're unaware, what's that guy's name? I forget his name, but the guy who's got the dollar milkshake theory. Forget his name. But there's a lot of these guys, especially really into the macro. They expect this this major dollar pump, and what Hugh's saying, there's this giant treasury pump. So the final not capitulation, the opposite of capitulation, the final pump will be humongous for the treasury, where all money will get sucked into that, risk on assets being destroyed, that being Bitcoin, for a period of time. Could be a short period of time, could be a day, could be a week. I don't know how long this is proposed to be, but that will be it. That'll be the end. And then so he is going to be trying to short treasuries as much as possible once that spike occurs.
So the interesting part here, which we also touched upon at the beginning, which is there's risk involved, and risk goes up when volatility goes up. Which means that you can make a hell of a money or a lot of money during the year that everything goes up. But you can also lose it all if you're not very acknowledged or knowledgeable about the markets and understand the dynamics. Like a retail investor isn't going to understand that once the markets start to crash and their Amazon stocks fall, that they need to buy treasuries. That's just not going to happen. But if we are going to repeat 1928 or 1998, we have 1 to 3 years of actual upside and then probably 2 to 3 years of drastic downside. What is I think you touched it with Bitcoin as well, but what is your, I would say, advice to a game plan when it comes to the upcoming years?
Yeah, well again, is why my beginning was so seemingly light or unambitious. When I said 5,700, I'm long. Below it, I'm less so. The thing that investors get wrong, the most damaging error they make is swinging around, and you'd think that I'm encouraging that. History just demonstrates that you want to have a diverse a diversified portfolio and be kind of long.
Naturally, yeah.
And so I'm like, you want to be long stocks. The equal weighted S&P. Yeah, it's only the last 2 years it went up like on average 12%. It's not that bad. It's not that hard. Even with the Mag 7 valuations, I mean, Microsoft's not going bankrupt, right? So you will not be wiped out. Your returns over the next 10, 15 years, if you're buying those stocks now, you might be flat for the next 15 years. But if you're young enough, you're going to recover from it. And someone very wise, who was it, was saying that the key is drive your car really fast, but make sure you've got really good brakes. It's funny, like I'm in St. Bart's, and one of the top Formula One drivers, what's he called? George
Russell.
Yeah, he's staying here just now. Lovely kid, and very down to earth. No entourage. He goes to my gym. No personal trainer. Zero body fat. No muscle, but whatever. But good brakes. Drive really, really fast. So what are my brakes? I'm saying to you, well, first of all, look at my chassis. I'm saying I'm long risk. We're above 5,700. I am receptive. I'm taking it on. If you will, I'm fully invested, whatever that means. Okay. But I've predetermined a level where I will kind of go, but even without that, I've got the brake, which is my SOFR contracts. That I'm betting on something which could make me a lot of money in the absence of the stock market doing well. So diversification.
I wish I had better understanding of all these different techniques or instruments that are usable. Like he's talking about this SOFR trade. I don't know what the hell that shit is, but I just got crypto, baby. Crypto, I understand. Bitcoin, I understand. All these different financial instruments. I still have a lot to learn.
Diversification is the key to that.
I think you mentioned that external money comes in as the price goes up.
Yeah.
And just when you were saying that, I was just, isn't the same principle applied to Bitcoin nowadays? We've got the ETF, which has been created last year around this actual period. And we have a constant flow of institutions buying into Bitcoin through the ETF. And there we go, Bitcoin goes up, creating its self-sustained sort of supply shock. What's your thesis behind having Bitcoin in your portfolio at this point?
I mean, I have the dumbest thesis on Bitcoin.
Tell me about it.
I'm very proud of it. I mean, I think I invented it. I mean, as dumbass as it is, but it is twofold. I managed money professionally. Would you believe? I mean, I don't know if I did, but I certainly had a hedge fund, and when we looked at say, so I was in it to win it, right? When I looked to make an investment, I'm like, I want to make a lot of money because I'm going to worry about this thing, right? So I'm going to worry a lot. I want to be rewarded. So I've always had this, what do they call it? Where Peter Lynch, young people don't know who Peter Lynch is, but Peter Lynch was one of the first superstar Fidelity mutual fund managers, based out of Boston. And he wrote a book, One Up on Wall Street. It's a classic. And one of his demands was that his team of analysts, he probably had hundreds, they had to be able to condense their argument onto a yellow stick-it note. and if you couldn't get that, he wasn't interested. And so here's my attempt for Bitcoin. My attempt is that today, with now Bitcoin at what, 102,000, the entire market capitalization of Bitcoin, if we assume the full dilution of the 21.5 million digital coins, is, let's call it $2 trillion. I want to say that it has the proof of concept has been established, that there enough years have passed to say that it is an asset class, that big money has come in and said it is an asset class that we want to invest in, and it's the smallest asset class, that its closest competitor is gold, and gold has a market capitalization of $18 trillion, and it's probably greater than $18 trillion because we're not accounting for the creep in mining, gold mining output. I mean, gold will be diluted by a rate of 2.5% in perpetuity. Yeah. But let's call it $18 trillion. So my point is, Bitcoin could, why the upside to Bitcoin is at least the same market capitalization as gold, right? So for me, Bitcoin is something that could rise 8 to 9 times. And if it does so, it'll be trading at where gold is today. Now, that model doesn't work with gold because gold is $18 trillion. If and people, they constantly say it's going to triple. Okay, where would triple take it to? What, 8,000-9,000? At 8,000-9,000, gold would be trading at the same capitalization as all U.S. stocks. You know, that's with $3 trillion Nvidia's, Microsoft's, Apple. And I'm a fantasist. I can imagine a great deal of things. I cannot imagine gold consuming that amount of market capitalization mass. The stock market, can it triple? It would be $150 trillion. That's 1.5 times global GDP. That is 8 times US GDP. I can't see that. So of all the asset classes in the world, Bitcoin can triple. So if it just triples,
Yes,
it doesn't change the chemistry of the universe. Yeah, it would trade on what? It would trade on two Nvidias. That seems eminently plausible. And then I have a catalyst. I have 2 catalysts: the creation of the ETF, which was big money. So big money is like, we have got a problem. Okay, we are the casino, right? And we need people. We make money with people putting money in the slot machine, right? We're slot machine providers, right? But we need people coming in. But when the stock market is capitalized at $60 trillion, people are like, I'm a little bit worried about coming to the casino. It seems a bit rich. When gold is at $3,000, yeah, there's a few head cases, but most people are like, I feel like I missed it. Yeah.
What if I think gold's going to
guys,
50
we need
grand?
a new casino. I need something which is small, and people are going to come in and they're going to keep putting money into the slot machine, and I make money. And someone goes, Bitcoin. They're like, genius, right? And so the ETF is the casino, right? And then finally, remember I was saying to you that the S&P, we mentioned 1982. Now, 1982 was significant for many reasons, but that roughly coincides with the creation of listed options on the S&P. When you introduce listed options, it's like the analogy I make is with banking. Investing becomes fractional. You know, like $1 of loan creates a cascade of 8 to 12 to $15 of new.
All right, if you can get that whole little surmise thing you did on BTC, it's just that BTC is now proven, it's been around long enough, it is now considered officially an asset class, and BTC, by definition now, is the smallest asset class there is. So in his mind, it's a low-risk effort or a low-risk take. It's the smallest asset class there is. If he went to get in gold and trying to get a 3x on gold, for gold to get to 9,000, it would just be a humongous a market cap. And the only way, I mean, it's just unfeasible that that could occur. The only way that that could occur is if extreme money printing occurred, which I think is possible, but okay. So his strategy is coming from the idea that nothing overly universal changing happens. Assuming that things stay relatively where they are, and the amount of money that we have, the M2 money supply, relatively stays where it's at or slowly grows, that gold is not going to get to 9 grand. And for Bitcoin to reach the market cap of gold, it's going to be a 10x. So of course that would be great for him and anybody holding. And it still would be okay. Like that wouldn't destroy the markets for Bitcoin to 10x from that point. So that's kind of his thought there, which makes sense. And that the biggest money, all the market makers, with the ETF coming out, when everything starts to feel overvalued, get expensive, people stop buying, and they need people to buy, so they bring the Bitcoin ETF so people will buy
money. Yeah, and that's what I see. So when you introduce listed options, and we're in the infancy, the amount of money that's going to come in to Bitcoin is enormous. So can it go down? Sure, but everything can go down, and yet this is the one asset class that if it works, it really works. So that's my simple case on Bitcoin.
I mean, if we talk about Bitcoin, then there are like 3 questions that pop up. So I'll just go on with them. First one is, Trump also has a similar view, I think, where he wants to create a Bitcoin strategic reserve, which to me feels like he wants to copy Russia and China, which these countries have been piling up their gold in the past decades, and he wants to do it with an asset that actually goes up in value.
Well, I mean, I don't care. It's just noise. It's just narrative.
I mean, it's good for being a Bitcoin holder that he wants to create his own strategic reserve, but I just don't know what type of impact it's going to have.
I'm indifferent. Central banks and governments, where the Bank of England sold half of all of its gold deposits.
Yeah.
In 2003.
Stupid.
Apparently they're clever, and yet they held it. They watched it decline from $850 to $300 from 1980 to 2003, and then they gave up on it.
Wasn't 2003 the low?
Yeah, the Bank of England sold half of his gold reserves at the low.
Wow.
So when people tell me, "Oh, I'm bullish on this or that because the government's buying it, because the central bank's buying it, or they're selling it," I don't care. Like, tell me what Stan Druckenmiller's doing. Don't tell me what Trump's doing or the Treasury's doing. So for me, it's tittle tattle. I can see the attraction, but and it wouldn't make any difference if the capitalization of Bitcoin was $20 trillion. If it was $20 trillion and Trump was launching a sovereign fund, I don't think it would affect the long-term expected return. The key determinant is it's too small in the universe of global financial speculation. Mm-hmm. It can be driven multiple times higher because within the constraints of existing savings institutions and money supply, credit availability, is a lot easier to amplify the price of Bitcoin than any other asset class apart from individual names. I
think the annual return rate for Bitcoin has been between 40 to 65% since its existence on average. So especially when it keeps being this small, it continues to go up with this average return over the years to come. And that brings me to, the new, let's say, alpha man in Bitcoin and crypto, which is Michael Saylor.
I keep seeing him eat a tater tot.
Which is just pulling the strings when it comes to borrowing money, putting it into Bitcoin, borrowing more, using Bitcoin as collateral, and continues to do so. Do you keep up with anything that he has been doing or with his strategy? And if so, what is your view on that? There, in my opinion, it's a genius move if it plays out. But the counterparty has a lot of risk as well.
Yeah, I don't disagree with that. I would do the same in his shoes, but it does have is it complex? It has a striking morality asymmetry that it requires someone. It requires someone to be a promoter, someone to be, if you will, a shill, whatever that means, and it requires a lot of dumb people.
Yeah, well, there are a lot of dumb people in crypto, so
Yeah, but so Michael's effectively is like he can sell the stock has no value except its reserve of Bitcoin, and he can sell that for 3 times the prevailing price of Bitcoin to buy more Bitcoin. And he should do that as long as the circumstances permit for it. But why would anyone facilitate that? Now, there's an argument that that situation owes itself to the absence of a listed options market. And so he's getting financing essentially via the converts. And within the converts, there is an embedded 3-5 year option. And if I could, where would a listed Bitcoin 5-year option, where would that trade today? It would be, with the volatility, be very rich. So Michael's situation will disappear as the listed option market really, really takes off. There will be no need for that silly behavior. And there'll be, he'll be a Cathy Woods, that more people will have invested with him and lost money than people who've invested with him and made money. If you understand, because it eventually is kind of a Ponzi scheme, and the initial gets the return, and the people who come in too late they are the exit. Yeah. So, but again, if you can sit there owning Bitcoin or owning, so presently I think your options are mostly on the ETF. There's a future. Liquidity is not great. They don't go out very far. But he's your best friend. Yeah. Every day he's selling stock and he's buying Bitcoin. And owing to the liquidity, the pricing is not very professional. And so there are some, if there was a kid and he was insisting on being involved in investing, I would say become super smart on options and sit there and trade listed options in Bitcoin for the next 5 years. A question for you. What do you think the expected return on Bitcoin would be?
I will try to get super smart on options and focus on that for the next 5 years.
If it was trading at $1 million?
I think less.
You don't say.
I think less, yeah.
Of course. It would.
It's a curve, right?
It would be gold. It would be gold. It would be the stock market. And
that's why you've got a window of a few years to actually make that return, because after that it becomes boring, as there's a lot of hedging and options and ETFs involved. So it's gonna trade exactly the same as gold is. So that's why they jump onto the bandwagon right now and just have, maybe it's going to be 6 years. Who knows? I don't know. It's going quite fast.
I think it will go faster and faster.
Yeah.
I think it will accelerate. But
that maybe coming back to 1928, 1929, Bitcoin doing this could be the ideal version of the bubble. I truly stand by that actual case that in the final years of the S&P surge, Bitcoin probably picks up its bubble momentum, where all the institutions jump into an even more risk-on asset, which is called Bitcoin.
Yeah. So again, I started by saying we've had 20% up years in the S&P.
Mm-hmm.
And in the 1990s, we had 4. And so if we're going to repeat the 1990s with the bubble of AI, there's another 20% plus years. If that happens, I think Bitcoin will trade a lot closer to 1 million in that period. And I think it will lose its correlation with NASDAQ over that period. However, if that doesn't happen and we do get the death of money, and we see a substantial decline in stock prices, I do think, I think Bitcoin will trade significantly lower.
Mm-hmm.
But it would be an asset class that I'd want to commit to on falling prices. Bitcoin is like what do I want to call it? It's almost like a covered call. Like the volatility is so great that the present level I find comforting, and it could just be an income product.
Mm-hmm.
And it's trading at 100,000. And at 50,000, I want to buy like 4 times as much as I have today. At 20,000, I want to buy 10 times as much,
Yeah.
And so if I can generate income all the way down, yeah, not bad.
Final question. If we summarize that this period is comparable to some periods we've seen in the past, well, not by our own eyes, but we have been reading it in the books and seeing it on the charts. We all kind of know what gold has been doing in the 1930s. Could Bitcoin serve the exact same role as gold did in the 1930s after the crisis starts? So that there's a bigger sort of, they call adoption or level of uncertainty, so people fly out of the system into crypto and Bitcoin, just like they did with gold back in the day.
Well, what did gold do in the 1930s?
It surged in price.
Well, did it really? Like it was confiscated.
That's true.
It had a step function it was like a currency and it had a step function higher vis-a-vis fiat currencies, but it was largely withdrawn from circulation. You were in the largest market on the planet. You couldn't own it. Largely that was to prevent further bank runs. Okay. We do have the experience of the gold mining equities, like the precursor of new mode. I believe that it certainly outperformed the general stock market. We don't really have listed equities. It's with the advent of Trump, it's unlikely that it's going to meet a regulatory confiscation. That seems unlikely. I don't know. My view is that,
he's just asking, after the collapse, is Bitcoin going to be the place that everybody runs to, like they did previously to gold?
In a 1930s death of money scenario, the price would be perhaps closer to 25,000, and it would certainly be the only thing that I'd want to accumulate at that point.
Well, I'm going to thank you. This was a wonderful conversation. I really, really liked what you have.
I warned you that was going to be heady. If you like going through these difficult conversations, these difficult interviews, and trying to get me to break that down a little bit, if that's helpful for you, let me know. I'll try to do more of them. It's good to understand. It's good to listen to people who know a lot more than you do and try to understand piece by piece of it. Until next time, if you enjoyed this video, you want to support my work, there's a Bitcoin address below you can check out. You can look at the most elegant monkey ever for my favorite meme coin. In fact, the only meme coin I hold and will hold. And in terms of utility tokens, Quant and Constellation Network to me are the standouts right now. Stay elegant.